Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 26th of October 2020 and we're going to talk about bonds. Not James Bond, but corporate bonds. Why? Because they may not be the security investors may think they are. And that will have major repercussions for the equity markets moving forward and quite possibly prove beneficial for precious metals. So let's take a look. Now, before we talk about bonds, yesterday we produced episode 3 of our Peak Gold series. Are we reaching peak gold? And we've provided links to all 3 videos in that series in the description box below. Now, today we're talking about bonds, essentially corporate bonds, and we highlight why investors may indeed find themselves with burnt fingers soon if they haven't already done so. As of August 2020, ICMA, the International Capital Market Association, estimates that the overall size of the global bond markets in terms of US dollar equivalent notional outstanding is approximately $128.3 trillion. I'll repeat that, $128.3 trillion. This consists of $87.5 trillion worth of SSA bonds, which is 68%. Now, they are basically sovereign, supranational and agency bonds, regarded generally as pretty darn safe. And 40.9 trillion, in other words, 32%, 40.9 trillion corporate bonds, which traditionally were regarded with a mixture of safe levels, but normally, very often, accepted as quite reasonable security. Now, in terms of country of incorporation, the global corporate bond markets are dominated, admittedly, by the US, where the value comes to about $10.9 trillion, and then followed by China of $7.4 trillion. Between them, they make up 45% of the total global corporate bond market. 53%, which is $21.5 trillion, of outstanding corporate bonds are issued by financial institutions. The problem is, however, how safe are these investments? And a report by Bloomberg today suggests perhaps not as safe as one might think. We shall take a look. Now, we have to admit to you in advance, this is quite a long article. It's approximately 9 minutes long, marginally technical, so please be prepared for it. But we believe it's well worth looking at, because it does have some serious repercussions down the road. So let's take a look at this report, published earlier today. Bloomberg article dated 26th of October 2020. Headline: Bond defaults deliver 99% losses in new era of US bankruptcies, by Jeremy Hill and Max Reyes. 3 cents, 2 cents, even a mere 0.125 cents on the dollar. More and more, these are the kinds of scraps that bondholders are fighting over as companies go belly up. Bankruptcy filings are surging due to the economic fallout of COVID-19, and many lenders are coming to the realization that their claims are almost completely worthless. Instead of recouping, say, 40% for every dollar owed, as has been the norm for years, unsecured creditors now face the unenviable prospect of walking away with just pennies, if that. While few could have foreseen the pandemic's toll on the economy, the depth of investors' pain from corporate distress was all too predictable. Desperate to generate high returns during a decade of rock-bottom interest rates, money managers bargained away legal protections, accepted ever-widening loopholes, and turned a blind eye to questionable earnings projections. Corporations, for their part, took full advantage and gorged on astronomical amounts of debt that many now cannot repay or refinance. It's a stark reminder of the long-lasting repercussions of the Federal Reserve's unprecedented easy money policies. Ultra-low rates helped risky companies sell bonds with fewer safeguards, which creditors seeking higher returns were happy to accept. Now, amid a new bout of economic pain, the effects of those policies are coming to bear. Debt issued by the owner of Men's Warehouse, which filed for court protection in August, traded this month for less than 2 cents on the dollar. When JCPenney Co. went bankrupt, an auction held for holders of default protection found the retailer's lowest priced debt was worth just 0.125 cents on the dollar. For Neiman Marcus Group Inc., that figure was 3 cents. The loose lending terms that investors have agreed to mean by the time corporations file for bankruptcy now, they're often exhausted their options for fixing their debt loads out of court. They've swapped their old notes for new ones, often borrowing against even more of their assets in the process. Some have taken brand names, trademarks, and even whole businesses out of the reach of existing creditors and borrowed against those too. While creditors always do worse in economic downturns than in better times, in previous downturns lenders had more power to press companies into bankruptcy sooner, stemming some of their losses. The pandemic is upending industries like retail and energy, making it unclear how much assets like stores and oil wells will be worth in the future. The underlying problem for many companies, though, is that they have astronomical levels of debt after borrowing with abandon over the previous decade, then topping up with more to get them through the pandemic. For bondholders, the kind of liabilities that companies have added makes the problems worse. Loans have been a particularly cheap form of debt for many companies over the last decade. Those borrowings are usually secured by assets, leaving many corporations with more secure debt than they had historically. That means that unsecured bondholders end up with less when borrowers go broke. We'll see companies gradually hitting the wall. It's just a question of when and how fast, said Dan Svern, founder of Arena Investors, a $1.7 billion investment firm with an emphasis on credit. There's just going to be way more downside. The recent low values for bonds in credit derivative auctions signal that in future bankruptcies, owners of unsecured bonds, not to mention loans, may suffer a bigger hit than usual, according to research from Barclays plc. The median value for companies' cheapest debt in credit derivative auctions this year is just 3.5 cents on the dollar, a record low and far below the 23.4 cent median for 2005 through 2019. The value of a company's bonds in an auction for credit derivatives payouts doesn't necessarily equal how much money bondholders will actually recover when a bankruptcy is complete. But lower auction values do tend to correlate to lower recoveries, according to Barclays. Lower market values also reflect investor concerns. The auctions represent the value of a company's cheapest unsecured bond, although usually most of a borrower's unsecured notes trade around the same price in bankruptcy, according to Barclays. When a company defaults or files for bankruptcy, an investor that bought a credit default swap receives a payout equal to 100 cents on the dollar minus the auction value of the cheapest to deliver security. But it's not just bond investors that will suffer from low recoveries. Amid the pandemic downturn, loan investors could find themselves losing 40 to 45 cents on the dollar, compared with historical averages of 30 to 35 cents, according to Barclays. One factor that is hurting money managers is the erosion of investor protections known as covenants, as more and more high-yield and leveraged loan deals are covenant light, meaning they feature minimal such safeguards. When corporations had more restrictive covenants, borrowers had less room to fix their debt outside of court, sending them into bankruptcy closer to the first sign of trouble. Now, companies have more leeway to seek extra financing when they're in trouble and to give lenders providing additional funds the right to jump to the front of the line if the company does go bankrupt. Covenant-light paper usually means by the time you get back to the table with the borrower, the house is on fire, says Sanjeev Kemlani, a senior managing director at FTI Consulting. All of that extra time you had before, that's just gone away. Investors that bought a J. Crew Group Inc. term loan at par back in 2014 may have thought they were making a relatively safe bet since it was secured debt. When the company started struggling a few years later, it moved intellectual property, including its brand name, into a new entity, a move enabled by relatively loose covenants. The company then exchanged some of its existing bonds for new notes secured by the intellectual property, as well as preferred stock and equity in its parent company, as part of a broad restructuring. Loan investors ended up suffering. After the company filed for bankruptcy in May, the 2014 obligation was worth less than 50 cents on the dollar, according to Bloomberg loan valuation estimates. J. Crew exited bankruptcy in September. FTI's Kemlani, who advises lenders with senior claims on borrowers' assets, said investors should make an effort to put some teeth into their agreements, with borrowers now, as they fall into distress, regaining some loss protection. In addition to shifting assets, companies have also been doing more distressed exchanges in recent years, where troubled corporations offer creditors new debt that often ranks higher in the repayment pecking order in exchange for relief like lower principal or later maturities or both. Creditors that participate can stem their losses in the event of a bankruptcy, but investors that sit the deal out can end up worse off. The popularity of distressed exchanges has also contributed to a general rise in secured debt in companies' capital structures. That means that more investors, holders of loans and secured bonds, are fighting for the same scraps when a company files for bankruptcy. Almost 20% of the debt in the US high-yield bond market is now in some way secured, according to Barclays, versus just 6% in 2000. The number of businesses that had taken out just loans and no other form of debt almost doubled between 2013 and 2017, according to JP Morgan Chase & Co. data. Okay, we hear you ask, what has this got to do with the price of gold and silver? Why should I even be bothered with looking at this? Well, there is a potential chain reaction developing. Firstly, of course, corporate bonds will become less desirable. Secondly, there may even be a panic sell-off, and those proceeds have to go somewhere. And also the Fed itself has begun buying investment grade and fallen angel bonds to take up the slack. And if no one wishes to acquire these bonds, who's to say how quality the investment grade depreciates? It also means that as creditors start to model in far lower recoveries in the future, they'll demand more in terms of yield and current income, which again will in turn result in ever more Fed intervention, thereby ultimately, and this is the key, devaluing the dollar because even more currency is produced and enabling precious metal prices to rise. And bearing in mind that I've already mentioned the size of the US corporate bond market, one can see this hitting the US dollar perhaps more so than many other countries. Now, admittedly, this is a circuitous route, and not necessarily one that will occur in linear fashion, but it does not bode well, taking the next 12 to 18 months into account. And this is yet another reason we're positive precious metal prices, well into 2021 and 2022, even more so than we are perhaps for the remainder of 2020. Let's just wait and see what happens, but meanwhile, do share your thoughts. Thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so that you're notified of our videos as and when they are published. And we've also earlier published a video on the Richard and Greg channel, The Egyptian Empire, or Empires and Dynasties, Egypt. Thank you once again, and do pop over to that channel. Again, hopefully subscribe in there as well. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.